Investors are waking up to a stock market collapse of near biblical proportions. Since April last year, the Nigerian market has lost around 5 trillion naira. That's about $33 billion or 65% of market capitalization. Analysts say the global financial meltdown leading to a liquidity crunch and to some 300 billion naira worth of margin loans are to blame.
The first thing the regulators did was, CBN, SEC, Nigerian Stock Exchange, we admitted that to a certain extent, we were flawed in what we did, and by doing that, the next thing one has to do is you've got to show people what you're doing to rectify the situation. If you go back to last year, at one time, for example, the central bank was saying that all the banks were okay. Now the central bank has come out and said there is a problem. The Securities and Exchange Commission said everything was okay in the market, and we tried to talk the market up. Now even the Securities and Exchange Commission is doing spot checks on financial institutions, calling them to order, and obviously sanctioning people who have stepped out of line. Likewise, the stock exchange, delisting some new companies who are not adhering to the listing rules.
Now regulators are at ends to make sure this doesn't happen again. They're designing regulations and oversight functions that they hope will promote market growth and restore confidence. The Securities and Exchange Commission, which is the head honcho of regulatory bodies in Nigeria, is conducting spot checks on listed financial institutions, while subsidiaries are monitored by supervisory agencies. The idea is to stop banks from merely declaring paper profits, but instead show their value in tangible terms. The Securities Commission also wants banks to increase real sector funding, as opposed to providing margin loans to stock market speculators. The Nigerian Stock Exchange has also hardened its stance, delisting a total of 9 companies which haven't followed the bourse's post-listing rules. The government is also making efforts to clean up the industry, with the National Assembly's Capital Markets Committee said to be tightening investment laws.
People are going to think it's business as usual, and if they think it's business as usual, they're not going to come back into the market. The whole world is looking at us. So, I think that is the main thing. The regulatory regime is to be looked at. That is what we're looking at, and we're being totally honest with ourselves.
For stockbrokers, well, they're under constant surveillance by teams from the Securities Commission and the Stock Exchange during trading hours. Already 2 stockbrokers are in court defending themselves against charges of share manipulation.
In any market, confidence is key, but the economy too must be strong. The economy must be strong. The values of those shares are driven by the worth of the economy. What is it doing? Is it good? All right? Are the manufacturing companies that are quoted, are the services companies that are quoted, are they doing well? If they are doing well, then they'll be able to pay dividend. If they pay dividend, then people will have confidence in buying in the hope that they will get their money back. So confidence is it. And between confidence and the strength of the economy, one drives the other.
Regulatory authorities are also working on increasing the diversity of investment products, with plans to strengthen the nation's bond sector. On that front, the National Pensions Commission says it plans to invest 1.3 trillion naira next year, deepening this section of the capital markets. While the reforms may seem a bit extreme and rather Big Brother-like, they've got the full support of the Finance Ministry, the Debt Management Office, and the Central Bank of Nigeria.